While the public was watching prices climb and charts ignite with a kind of optimism that hadn't been seen in years, a very different reaction was taking shape behind closed doors. On the surface, the movement looked almost poetic. Decades of compression finally giving way, resistance levels that had humiliated buyers for years cracking one by one. Momentum feeding on itself with that rare electric feeling markets sometimes give when price stops negotiating and starts escaping. But markets are not judged by how they look when they behave as expected. They are judged by how the system responds when they don't. Because when a market begins to function the way textbooks describe, when demand asserts itself, supply tightens, and price discovery finally breathes, it doesn't just move numbers on a screen. It exposes structure. It reveals who needed control to survive. It tells you which positions only worked under artificial conditions. And most importantly, it shows you whether the system was built to absorb truth or suppress it. For years, silver existed in a state that many had learned to accept as normal. Price ceilings were treated as technical realities rather than symptoms. Volatility was framed as something dangerous rather than informative. Analysts who pointed out structural pressure were dismissed as alarmists, conspiracy theorists, or relics clinging to outdated models. Yet pressure doesn't disappear because it's ignored. It accumulates. And when it finally released, it did not arrive as chaos. It arrived as clarity. The first reaction was not celebration. It was discomfort. Quiet discomfort at first, then unmistakable panic. Not among retail traders or commentators chasing headlines, but among institutions whose survival depends on stability that can be managed, shaped, and predicted. Because a free market is not dangerous when it moves slowly. It becomes dangerous when it moves honestly. What followed was not framed as intervention. It was framed as responsibility. The language mattered. It always does. When volatility increased, it wasn't described as information. It was described as risk. When liquidity tightened, it wasn't described as scarcity. It was described as disorder. And when price began revealing imbalances that had been buried for years, the response was not transparency, but protection. Protection for whom was never clearly stated. This is where the public narrative and the institutional reality began to diverge. To the outside observer, the announcement sounded calm, almost reassuring. Trading pauses were introduced as safeguards. Rule adjustments were positioned as technical updates. Oversight was emphasized, neutrality repeated, and stability promised. But neutrality has a tell. The first sign of panic is always the same. Those who claim to be observers stop observing and start intervening. Because true neutrality doesn't require action. Only threatened systems do. A trading halt, in theory, sounds reasonable. A timeout. A chance for emotions to cool. A safeguard against irrational behavior. That is how it is sold. That is how it has always been sold. But what those words actually mean depends entirely on when they are used, and who benefits from the pause. If trading is halted when price collapses, it's called protection for investors. If trading is halted when price rises too quickly, it's called protection for the market. Notice the asymmetry. Losses are allowed to discover themselves freely. Gains, when they move too fast, are treated as suspect, and that alone tells you everything you need to know about how the system truly views risk. Because volatility is not inherently dangerous, uncontrolled outcomes are. The silver move didn't break the system because it was irrational. It stressed the system because it was rational, because it exposed years of mismatched positioning, leverage built on assumptions of endless control, and supply promises that only functioned under suppressed demand. Price was not misbehaving. Price was remembering its role. And that is when rules began to change. Not dramatically, not loudly, but precisely. Margin requirements adjusted, position limits revisited, settlement terms scrutinized. Each change on its own seemed technical, boring even. But taken together, they formed a pattern that was impossible to ignore. The system was tightening its grip. This is the part that rarely makes it into mainstream discussion, because it requires asking an uncomfortable question. If markets are free, why do they need to be managed so aggressively when they start working? The answer lies in structure. Modern financial markets are not neutral arenas. They are engineered ecosystems, optimized over decades to maximize liquidity, predictability, and, above all, confidence. Not confidence in price discovery, but confidence in continuity. Continuity for institutions whose balance sheets depend on prices behaving within acceptable ranges. Continuity for intermediaries whose models assume volatility that can be hedged, forecasted, and contained. Continuity for a system that prizes smoothness over truth. Silver disrupted that smoothness. Not because it rose, but because it rose without permission. When analysts who had been ridiculed for years suddenly found their models validated in real time, the discomfort deepened. When long-suppressed signals began flashing across multiple timeframes, the narrative control began to slip. And narrative control is not optional in modern markets. It is essential. So the story shifted. This was no longer about supply and demand. It became about speculation. It was no longer about structural imbalance. It became about retail frenzy. The move was reframed not as a consequence of years of pressure, but as an anomaly, something external, emotional, irrational, anything but structural. Because acknowledging structure means acknowledging responsibility. And responsibility is dangerous when it leads back to design choices that benefited some participants at the expense of others. Behind the scenes, the tone was different. Risk committees didn't ask whether price should be allowed to rise. They asked how much volatility the system could tolerate before confidence cracked. Clearinghouses didn't debate fairness. They debated exposure. Regulators didn't focus on transparency. They focused on containment. This wasn't coordination in the conspiratorial sense. It didn't need to be. Systems don't require secret meetings to behave defensively. They are built to do so automatically. Like gears interlocking under stress, every mechanism moved exactly as designed. Psychology met mechanics. When price accelerated, the system applied friction. When demand overwhelmed supply, the system delayed execution. When the signal became too loud to ignore, the system changed the environment in which the signal existed. And then came the words that should make any serious participant pause. Trading suspended. 3 words. Calm, official, sanitized. They sound like safety. They sound like protection. They sound like a responsible timeout when things get too hot. But what they really signify is that the market has reached a point where honest outcomes are no longer acceptable. The suspension is not neutrality. It is a choice. It chooses which prices are allowed to print. It chooses which participants get time to adjust. It chooses whose risk matters most. And it is never applied symmetrically. When trading is suspended during upward pressure, it disproportionately benefits those who are structurally short volatility, those whose exposure depends on prices staying within predictable bounds. It gives them time to hedge, reposition, negotiate liquidity, and restore control. Those who are long the move, those responding to the signal rather than shaping it, are frozen. That is not protection. That is intervention. The irony is that these measures are often defended as necessary to preserve confidence. But confidence in what? Confidence that prices reflect reality? Or confidence that the system will not allow reality to surface too quickly? Because true confidence does not require suppression. It requires resilience. And resilience is precisely what was being tested. The silver move was not an attack on the system. It was a stress test the system had postponed for years. And when it finally arrived, the response revealed more than any price chart ever could. It revealed that the system was not designed to absorb honest outcomes. It was designed to manage them. And management, by definition, implies control. As the situation unfolded, one thing became increasingly clear. This was not about protecting investors from volatility. It was about protecting structures from exposure. It was about buying time, time to unwind, time to rebalance, time to restore the illusion of order, because markets can survive volatility. They cannot survive loss of narrative authority. Once participants begin to question why rules change only when certain thresholds are crossed, confidence doesn't evaporate overnight, but it erodes, quietly, relentlessly. And erosion is far more dangerous than panic. This is why the response was so measured in tone and so aggressive in effect. Everything had to appear procedural, boring, administrative. Nothing could look emotional, because emotion would reveal fear. And fear, at the institutional level, is the one thing markets are never supposed to show. Yet it was there, embedded in every adjustment, every pause, every carefully worded statement about stability and protection. The system had flinched, not because silver rose, but because it rose honestly. The uncomfortable truth is that markets do not panic when prices move. They panic when control slips. A functioning market is not dangerous to participants who are positioned honestly. It becomes dangerous only to those whose exposure relies on predictability enforced by structure rather than discovered by price. And that distinction is never discussed publicly, because it undermines the foundational myth that all participants play under the same rules. They don't. What unfolded was not chaos. It was choreography. Every adjustment followed a familiar pattern, small enough to be defended individually, significant enough to alter outcomes collectively. Margin requirements weren't raised because volatility demanded it. They were raised because leverage existed where it wasn't supposed to be seen. Position limits weren't revisited to ensure fairness. They were revisited to compress pressure. Settlement mechanisms weren't scrutinized because of operational risk. They were scrutinized because physical constraints were becoming visible. Visibility is the enemy of managed systems. For years, the promise embedded in paper markets was abundance. Liquidity implied availability. Contracts implied delivery. Exposure implied hedging. But these promises only function as long as not everyone asks the same question at the same time. What happens if this has to settle honestly? That question was no longer theoretical. When demand stopped being speculative and started becoming directional, when it shifted from price appreciation to price truth, the illusion of infinite elasticity began to fracture. Futures markets are exceptional at distributing risk as long as that risk remains abstract. They struggle when abstraction gives way to constraint. Silver didn't just rise, it forced reconciliation. And reconciliation is expensive. It requires acknowledging mismatches between paper claims and physical reality. It requires explaining why certain participants have exemptions, others don't. It requires confronting the fact that liquidity can be deep until it suddenly is in DTT, and when it disappears, it does so asymmetrically. The public was told that safeguards were being activated. Internally, the discussion was about exposure windows and failure points. This is where psychology and mechanics converge. From a psychological standpoint, the system had to reassert authority. Authority over narrative, authority over tempo, authority over outcomes. From a mechanical standpoint, it had to reduce stress without triggering cascading consequences. Those two goals are not always aligned, because calming the narrative often requires slowing the market. But slowing the market does not eliminate pressure. It redistributes it. It moves it from price to structure, from charts to balance sheets, from screens to clearinghouses. The pressure didn't vanish during pauses. It concentrated. Every moment price was frozen, positions were being evaluated, not by retail traders refreshing screens, but by institutions recalculating exposure under new assumptions they had avoided for years. What if this doesn't revert? What if this isn't a spike? What if the model is wrong? Those questions don't appear in press releases. They appear in emergency meetings. And emergency meetings are not about truth. They're about containment. The system did not ask whether silver should be priced differently. It asked whether it could afford to let it be priced differently. There is a profound difference. A free market answers the first question. A managed market prioritizes the second. This is why the intervention felt so subtle to casual observers and so loud to those who understood structure. To most, it looked like routine risk management. To insiders, it was an unmistakable signal that thresholds had been crossed. Not price thresholds, credibility thresholds. Once participants begin to suspect that rules are elastic, that they bend more readily in one direction than another, confidence doesn't collapse instantly. It decays. Participation becomes cautious. Strategies become defensive. Liquidity becomes conditional. And conditional liquidity is fragile. The irony is that many of the measures introduced were defended as necessary to preserve market integrity. But integrity is not preserved by selective enforcement. It is preserved by consistency. If volatility is dangerous when prices rise too quickly, it must also be dangerous when they fall. If trading halts are about investor protection, they must protect investors symmetrically. If rule changes are about fairness, they must apply regardless of who benefits. They didn't. And that selective asymmetry is the clearest signal of all. Because systems that believe in their own robustness don't need to intervene preemptively. They allow stress to resolve through price. Systems that fear exposure intervene early and often. Silver forced that fear into the open. The deeper issue was never the metal itself. It was what the metal represented, a reference point outside the digital abstraction of modern finance. Something finite, something slow, something that cannot be created to meet demand at the press of a button. That makes it inconvenient. Convenient assets are those whose supply can expand when needed. Inconvenient assets are those that impose discipline. And discipline is disruptive to systems built on flexibility and leverage. When silver began behaving less like a financial instrument and more like a constraint, the response was inevitable. Containment over clarity, management over discovery, stability over truth. This is why the most revealing moments didn't occur during the price surge itself. They occurred in the language surrounding it, in the careful phrasing of statements, in the repetition of words like orderly, temporary, precautionary, in the insistence that nothing fundamental was wrong. Systems rarely insist on normalcy unless they fear abnormal conclusions. And beneath the language, the machinery kept moving. Risk models were adjusted, collateral requirements recalibrated, counterparty exposure reassessed, all of it done quietly, efficiently, without acknowledging the catalyst that forced the changes. Because acknowledging the catalyst would mean admitting that the market had briefly escaped its intended parameters, and that is unacceptable. The truth is that the system does not hate volatility. It hates uncontrollable volatility. It does not fear losses. It fears losses that occur outside modeled scenarios. It does not resist change. It resists change that reveals structural dependence. Silver did all three. That is why the response felt disproportionate to some and insufficient to others. It wasn't designed to resolve the issue. It was designed to pause it, to stretch time, to allow recalibration without admission. Time is the most valuable asset in moments like these. Time allows leverage to unwind without panic. Time allows narratives to reset. Time allows attention to drift. And attention always drifts. Markets have learned that public outrage has a short half-life. Complexity accelerates forgetting. As long as explanations sound technical enough, most participants move on, but the signal remains. Once participants have seen that honest price discovery triggers intervention, they internalize the lesson. They adjust behavior. They trade not on fundamentals, but on expectations of control. That is how free markets slowly become performative. They look active, they feel liquid, they appear competitive, but beneath the surface, outcomes are shaped long before price gets a chance to speak. Silver briefly disrupted that performance. And even though the system managed to regain composure, something irreversible occurred. The myth of neutrality cracked, because neutrality does not require halts. It does not require sudden rule reinterpretations. It does not require narrative defense. Neutrality allows consequences, and consequences are exactly what were postponed. What remains now is not resolution, but memory. A collective awareness among serious participants that when pressure builds long enough and truth begins to surface, the system's first instinct is not to listen, but to intervene. That realization doesn't cause panic. It causes recalibration. And recalibration changes everything. The most dangerous moment for any controlled system is not when pressure builds, but when participants begin to remember that control is optional. Because once that realization takes root, behavior changes in ways no rulebook can fully anticipate. The silver episode did not end with the halt. It did not end with revised margins or adjusted limits. Those were surface responses. The real consequences unfolded more quietly, across desks and strategies, inside assumptions that had gone unchallenged for years. Markets have memory, even when institutions pretend they don't. Every trader who watched price accelerate and then freeze learned something. Not from the charts, but from the response. They learned where the invisible walls are. They learned how far price is allowed to travel before it becomes a problem. Not for the market, but for the system that governs it. And that knowledge does not disappear. It gets priced in. The next time pressure builds, participants don't just ask whether demand is real. They ask whether it will be allowed to express itself. They don't just model supply constraints. They model intervention thresholds. They don't just trade fundamentals. They trade governance. This is how markets evolve when trust erodes, not through collapse, but through distortion. Because a market that expects interference behaves differently than one that expects consequence. Liquidity becomes tactical rather than organic. Volatility becomes anticipated rather than informative. Risk is no longer something to be discovered, but something to be navigated around policy reactions. That shift is subtle but profound. It transforms the market from a mechanism of truth into a mechanism of expectation management. Silver exposed that transition in real time. The deeper issue was never whether the price move was justified. It was whether justification even mattered. Because in a truly free market, justification is irrelevant. Price emerges from interaction, not permission. But permission had become the unspoken variable. The system had grown accustomed to a certain rhythm, one where supply could be abstracted, demand could be smoothed, and volatility could be framed as noise rather than signal. Silver disrupted that rhythm by reminding participants that not all assets conform to digital elasticity. Physical constraints don't negotiate, they assert. And when they do, they expose leverage that only works in theory. This is why the response felt defensive rather than curious. A confident system investigates anomalies. A fragile one suppresses them. The intervention was not an admission of failure. It was an avoidance of acknowledgement. Acknowledgement would have required answering questions no one wanted to ask publicly. Questions about settlement integrity, questions about inventory transparency, questions about the relationship between paper representation and physical availability, questions about whether the system had drifted too far from its original purpose. So instead of answers, there was adjustment. Adjustment preserves appearances. It allows continuity. It keeps the machinery running without forcing a reckoning. And for a time, that is often enough. But adjustment does not erase memory. Participants remember which assets trigger intervention and which don't. They remember which moves are celebrated and which are restrained. They remember who is protected by pauses and who is immobilized by them. And memory shapes behavior far more than regulation ever could. The quiet recalibration that followed was not coordinated, but it was widespread. Strategies became more conditional. Exposure became more cautious. The willingness to trust unfiltered price discovery diminished, not because participants became irrational, but because they became realistic. They learned that the system prioritizes stability over symmetry, that outcomes are acceptable as long as they remain within tolerable bounds, that when pressure reveals structural discomfort, the response will favor those most exposed to disruption. This realization doesn't inspire rebellion, it inspires adaptation. Capital flows adjust, time horizons shift. Assets once viewed as neutral hedges are reassessed through a political lens. Risk is no longer purely financial. It becomes regulatory, narrative, institutional, and that changes the nature of participation itself. The silver episode was a reminder that modern markets are not arenas, they are managed environments, and like any managed environment, they function best when participants accept the boundaries without testing them. Silver tested them, not intentionally, not maliciously, simply by behaving like a market is supposed to behave when supply tightens and demand asserts itself. That alone was enough. What made the moment particularly revealing was how quickly the language of protection replaced the language of discovery, how swiftly volatility became framed as danger rather than information, how easily intervention was normalized as prudence. These are not signs of a system confident in its design. They are signs of a system prioritizing continuity over credibility. Credibility, once questioned, is difficult to restore. It doesn't shatter dramatically. It fades incrementally, replaced by cynicism, then pragmatism, then disengagement. Markets can survive cynicism. They struggle with disengagement because disengagement drains depth. It thins liquidity. It increases fragility under stress. Ironically, the very measures used to preserve stability often sow the conditions for future instability. By postponing resolution, they accumulate pressure. By managing outcomes, they encourage behavior that depends on management, and dependence is vulnerability. The silver episode did not resolve the underlying tension. It deferred it. It signaled that certain outcomes are negotiable, but only within acceptable parameters. That signal will be remembered. The next time constraints tighten, the next time pressure builds, the next time price begins to reveal something uncomfortable, the response will be anticipated before it occurs. Participants will not wait for discovery. They will front-run intervention. And when enough participants do that, price stops being a messenger and becomes a negotiation. That is not failure. It is evolution. But it is not the evolution most people believe they are participating in. The illusion that markets are neutral arbiters of value persists because it is useful. It encourages participation. It sustains confidence. It simplifies complexity into narratives that can be explained, sold, and defended. Silver complicated that illusion. It reminded participants that neutrality is conditional, that rules are flexible, that freedom exists until it becomes inconvenient. That reminder cannot be undone. The system will continue to function. Trades will settle. Charts will move. Headlines will shift. Attention will wander. But beneath the surface, something fundamental has changed, not structurally, but psychologically. And psychology is the substrate of all markets. Once participants internalize that honest outcomes may be delayed, reshaped, or suspended when they conflict with systemic comfort, they no longer engage with the market as a truth discovery mechanism. They engage with it as a managed process. That doesn't make markets useless. It makes them different. Different assumptions, different risks, different expectations. Silver did not break the system. It revealed its priorities. And in doing so, it forced a choice upon every serious participant, not between optimism and pessimism, but between belief and awareness. Belief says the system is fair by design. Awareness says the system is functional by management. One is comforting, the other is actionable. Those who understand the distinction don't panic when rules change. They observe, they adjust. They recognize that volatility is not the threat. Unpredictable governance is, and they position accordingly. The market moves on. It always does. But it does not forget.